Welcome back. Market Day Report here on a Tuesday, and the trade right back at it now and open for the 15 minutes now in the grain and livestock trade. And normally on a Monday, we start the week with our good friend Dewey Strickler, but I wanted to make sure we had a little chance to visit with him during this week. So, Dewey, thanks for readjusting the schedule and joining us here as we begin this holiday shortened week.
I'm glad to do so, Mark.
You've put out a newsletter each week called On the Money, and I wanted to have you share, before we get to the markets here today, some, I don't want to say concerns, just observations. I mean, you want to call it concerns, you can, but observations that you shared with Marlon and I wanted you to share with the others regarding production and demand and the money flow coming into these commodities.
Well, you know, obviously, commodities are viewed as an asset, Mark, and you have a lot of these investment banks. They don't necessarily have an opinion per se about corn, soybeans, or wheat, but they may have an opinion about what the ag economy is going to do, and they'll position themselves on that, maybe a rise in interest rates. And what they do, they go in and they buy the indexes, and the indexes are completely different from the trend-following funds. Trend-following funds are basically technical in nature, whereas the index funds generally have an opinion about, like I said, interest rates, the economy, and they're trying to position themselves, these wealth management groups, for their clients in regard to that.
You put together a graphic. I want to put that and show and have you go through this, corn, soybeans, and wheat, maybe in a little more detail for our listeners and viewers, and what these percentages mean.
Okay, well, first of all, when you look at corn, we've had a year-over-year increase in production of about 11.3%. And the demand has increased about 7%. So you're looking at a net change in production over demand in corn of 4.3%. Now, when you look at the index funds, and this is what's caught my attention, and my numbers have been updated here from the last Commitment of Traders report, but the index funds since first week of January, Mark, have increased their longs 17%. And that, you know, pretty well tells you that the demand in these grains is really coming from another source other than those, say, your typical meat and potatoes and supply and demand traders and so forth. This is coming from an outside source, such as your index funds. And in soybeans, we had a net change of production over demand of about 5.6%. And as of last week, the index funds have increased their position about 22%. Now, if you want to look at wheat, we actually saw production slip about 4.3% in relation to demand. So you can say, yeah, there is something here as far as supply and demand issues, but the index funds have increased their position or longs in wheat since January of about 30%.
Well, those are updated from the numbers you gave us this morning, so those are even more updated right now. But the bottom line is a lot of money flowing in here for reasons other than demand. I guess, is that the real takeaway here?
That is the real takeaway, Mark.
That's something to watch. Dewey, we're going to let you go here. We're going to keep the viewers and listeners updated here and talk a little livestock coming up here. But we appreciate your time this morning, and maybe keep track of those numbers as we go through into spring. Appreciate your time.
All right, thanks a lot.
Thank you, Dewey Strickler. AgWatch Market Advisors, agwatch.biz is the website. We will take a break, come back. Still going to check in with Ed Serwin as well. We'll get you updated, though, in the grain and livestock trade after this.